stuff working here? Okay, hopefully you guys can hear me. I'm in a totally new situation here with a whole new office. I moved from up in Logan, Utah, down to St. George, Utah, and I can't hear myself. I don't know if you guys can hear me. Maybe somebody wants to give me an okay, Lan, I got you, I got you. Sound check, sound check, sound check. Hello, testing, testing, testing. How come this thing's not working? I don't know. There we go. Albert, can you hear me? John, can you hear me? Yes, we hear. Okay, John says you got good sound coming through. Okay, I think I got my thing set here now too. All right, I can hear myself. Okay. How's everybody doing? Good to see you guys. All right, Chad says, Mr. Turner, does that mean you can hear me? I hope that means you seems that you can hear me. Okay. I'm back in a different place, so this is kind of running a little bit different system here. So I apologize for being a little bit slow today and behind the 8 ball. But we got a good class planned. Tonight we got class at the university. So that's why I'm down here, because classes at the university start, and we got our first class at the university tonight. Chad says he's going to be there. I think, John, I think I saw you on the list. You're going to be there, right? So Randy, are you going to be there? I don't know. Randy's probably like, I've been to that class about 42 times. So is Chad. So Chad's like, I'll be your proctor. I'll come and teach your class with you. All right, Chad, come on in. You can teach my class. I just turn it over to Chad. He's been there so many times. I think probably Randy's the same way. All right. So anyway, we got class at the university tonight. Next, I'm excited, looking forward to that. Get this show on the road. But today we're here online. Now, remember, the reason we're online, the reason I do these online classes, because these are the labs for the university classes. So a lot of you guys are students from St. George, and that's great. That's why we're here. Okay. Not that other people can't join and come and be a part of the club and party and hang out with us and look at markets and see if we can't make money. I mean, that's what it's all about, right? And I'm not here to tell you what to do. I'm just here to tell you what I do. Okay. And if you think you can learn a little bit from me because I'm like one chapter ahead of you in the Sunday school lesson manual, then great. Come along and I'll try and show you what I'm doing, and maybe you can learn a little something along the way. I've been doing this for about 30, 35, 40 years. So built myself up a pretty good portfolio, discovered lots of new and wonderful fun things to show people. So that's really all I'm doing. I'm just here showing you what I'm doing. All right. And so if you want to hang out with me and I'll show you how I do stuff and teach you along the way best I can, then you're all welcome. So that's what this is all about. Okay. All right. So let's come over here. Oh, first thing I wanted to do is I wanted to come over, and I don't know if this chart, it looks kind of different than what we were doing on the other system. So hopefully you guys can see it. I want to come back over here again. How did I get off that page? There we go. I want to come in here and I want to look at the news first. So the first thing we want to do is we want to look at the economic news. All right. So today, let's refresh this, make sure we got the right one up. So we got Tuesday, and we want to go to Impact 2. I'm not really interested in Impact 1 because Impact 1 doesn't really do a lot. But we got the Fed speaking again today. Fed Waller, 7 and a 130. But he speaks twice today. Are we done with the Fed yet? Existing home sales. They've been talking all last week. They were messing up with the economy with all of their words. Okay, Fed interest rate is coming on Wednesday. Forecast is 4.0. The previous was 4.2. So they're anticipating the Fed's going to drop the rates. All right, and that's the big thing. Fed conference 12:30. Afterwards 4 to 4:25. That's the big news that's coming up. All right. We've also got durable goods coming out on Monday, which is a few days away from now. And then nothing really happening today other than Fed Waller is speaking. We got a little bit of crude oil stocks coming in, but unless you're trading crude oil heavily, that won't mean a lot to you. Okay. So we got Wednesday. Nothing really there either. It's not till Thursday where I have existing home sales. Forecast is 3.9. Previous was 4. So they think home sales are going to go down. Existing home sales month over month down 2%. I think home sales are going to go down. That's the whole deal. Then we got jobless claims in here, 223. They think it's going to go up. So job claims are going to go up. That's not good. Of course, you know what? A lot of that is laying off. Those jobless claims are laying off federal workers. I don't know if you're for that or not. I'm a small government guy. I like to have small government, and our government has become bloated, in my opinion. We got way too many people. I mean, the reason Biden was able to have such good employment numbers was because he was hiring people to the federal government. I mean, anytime a politician, and it's both sides do this. Of course, Trump doesn't do this. He fires people. He doesn't put people, you're fired. He likes that kind of thing happening. So all the other politicians, whether both sides do it, what they do is they want to make their employment numbers look good so they have the federal government hire more people. And that's what causes a big bloated government. We hire more people so that we can have good jobless claims. I mean, that's the whole, it's a politician thing. So they can get, oh, see, we're creating jobs. You're not creating jobs. You're hiring people at the federal government, which is actually costing the American people more money. So now Trump's in there, you're fired, right? And they shut the government down. So he's going in, cutting all these different programs out. It's going to cause the jobless claims to go up because those people go out and claim, they got laid off. And so they claim their unemployment. What are you doing in North Carolina, Randy? You out there on business or pleasure? So anyway, that's the whole name of the game with jobless. So you have to be careful with that number because you might be happy that it's a lower number, right? Depending on your politics, I guess. If you want smaller government, you might be happy that we got a higher jobless claims. It's all, it's right now the economy is doing quite well. So it's not because the economy is doing poorly that we have jobless claims. It's because the economy is doing well and government's cutting employment. All right. So Friday, we got core inflation rates coming out. That's going to be an important one. 0.3. It's not going to change. They said that's good. Year over year, it's at 3. We'd like the Fed would like it at 2. I'd like it at 2. I'd like to see it below 2. I don't know why we have to have an inflation at all. I like no inflation. Excuse me. But, inflation, they want 2% inflation. That just means it's a 2% tax. Right now, it's a 3% tax. This is just another way of taxing your dollar. It reduces the value of your dollar, right? Your dollar goes down by, in this case, 3% every year. Year over year, you're losing a 3% buying power on your dollar. It's just another way of taxing us. So inflation rate, 0.4, that's month over month, but inflation rate year over year is the one that makes most sense to us. It says it's forecast to be 3 and previous was 2.9. So they say it's going up. So inflation's going up. That's not good, right? They're raising the taxes on us. All right, CPI, global Michigan consumer new home sale. Well, that's funny. Look, Michigan consumer sentiment. They took it off the red scale. Remember how I always complained about that? I always say, why in the heck can they make that red? Nobody cares about it. But they finally took it off the red. They don't claim it as a red anymore. New home sales, 0.69, 0.8. 0.69, 0.8. 8 is bigger. So that's new home sales going down again, month over month, down 13%. So if you're in the house if you're in the market to buy a house, prices are going down, and that's because interest rates are going up, right? Okay, durable goods on Monday is the next red one, and then clear down here, all the way down here, Fed interest rate decision next Wednesday, a week from tomorrow. So that's the one that's going to move the market. That's the one that's going to make the market tumble if they go up, and or tumble the other way if it go down. All right, so it should help the market. It's going down. If they drop it to 4 from 4.25, and then all this other stuff should go up. All home sales should go up. Unemployment should go up or down. All that stuff should be good if they bring the interest rates down. All right. We don't need to go out that far. We got the good stuff coming. All right, so let's come in here. The next thing I want to do is I want to talk about what was on our little marquee. Let's pull this up just real quick. And that was this right here. So this was our little marquee, yield first investing. So I got into a conversation, I might say, a conversation. It wasn't an argument. It was a conversation with somebody, one of our students the other day, and they just don't understand the concept. All right. They just can't get the understanding of yield first investing. So I want to talk about that today before we move into our charts. We want to go take a look at, last week we were, throwing some options out here. Look, we didn't do too well on some of these. We knew that though. We knew we were buying at the wrong time of the year of the run because it was just starting. So, but we put them on as a demonstration. But the market's pulling back, and so we said, well, kind of not the best place to be putting your money in there. We hadn't had any red bars. We were still on green bars. And so we wanted red bars, right? We said that, but we were putting them on anyway because we were in class. And that's what you do sometimes when you're in class. You don't time your trades the very best, but we learn how. So here we go. So this is what we're looking at on some of these markets. They're really tumbling. These are the markets that the federal government bought. All right. So here's one we decided we weren't going to get in. We were going to wait on that one. So that was but we put some in on some of these little markets as they were taking off and going to the moon based on the news that the government had bought all these. So these are all markets that the government bought. So they're all kind of tumbling back after the big initial rally. It's okay. We go put some more in now that they've tumbled back. That was the whole idea. All right. So let's come in here. We're going to go look at the rest of these, but I want to talk about yield first. And the reason I want to talk about yield first is because people don't understand the concept of our yield first investing. Okay, so we're going to take that down and we're going to bring this back up and we're going to come over here, see if we can go into our yield first investing. So the first thing I want to do is I want to go over to our little calculator here in Pitt News Magazine. Okay, so Pitt News, this is the address to this. It's called pittnews.com/dividend-calculator. And so what we're going to do is we're going to go through and we're going to put in here that let's say we have a $10,000 investment. All right, so we're going to have a $10,000 investment. And in that $10,000 investment, you can see that we have a list down here of all the different high yield returning stocks. All right. So these are ETFs, exchange traded funds, that have yield and gain. All right. Yield and gain. So what happens is when you go over and you look at a stock and you look at a chart and you say, okay, let's use Tesla, for example. We always like to use Tesla because everybody knows Tesla. This is Tesla outright. All right. This is the Tesla proper. So Tesla is set to report earnings this week with investor anticipation focused on key developments such as robotaxi updates and exclusive components. Now, I saw a question and answer that came out by Elon as he was answering questions for the investors, and he had a lot of positive things to say. Of course, he's Elon. I don't know anybody that's more positive about his own projects than Elon, but he has a lot of positive things to say about Tesla. Then he's anticipating this market's going to the moon. This is actually a little buy signal in here, as you can see that right there. We're coming in with a little buy signal. These stocks, these charts suck. How do I draw on them? I can't even draw on them. Anyway, we'll go back over here to this one. Let's pull up. Let's get off of the government purchases. Let's go into favorites. Oh, favorites. I just want something small. There we go. Tesla. That's the one we're looking for. All right. Now, again, I'm on a different system right here. And so hopefully you can see these charts. Okay, so this is actually Tesla coming into a little ABC pattern, right? So we got this whole movement that went in here. It took off. This is our first drive. So this is drive one. We're getting the counter trend. We're looking for drive two. We're looking for it to come up and break these previous highs up in here. Now, we've been anticipating this the whole time, right? We were right on this one clear down here. We buy in Tesla right here. This is where we put in our biggest purchase for Tesla right there, right? I'm getting all the wrong tools. Drawing trend lines with my arrow tool and drawing the arrow tools with my trend line. All right, it doesn't matter. You guys know what I'm doing here. Pointing to that little spot right there. That was our break. And then we had to sit through this big, long sideways thing. And then the market took off again for us. And that's all really good. Now, one of the things that people don't understand is that this is the growth model. All right, this is growth. The way you make money is if Tesla goes up, growth. That's good. Everybody wants the market to go up, even when you're in a yield first strategy. All right. Yield first means that you're more interested in the dividends than you are in the growth. Not that you're not interested in the growth, you certainly are. But if you have a sideways market like this, the growth model doesn't make anything, right? It's dead for 3 months, it makes no money. But the yield model can still make money during that time frame. It's not that your growth doesn't, you don't have to live 100% off growth, right? Live by the sword, die by the sword. That's basically what we're doing here. So when you come in here and you take a look at this market, if you have some yield during this time frame, that's really good because you can still get some income, you can still make some money. And then you like the growth too. It's not that you don't want growth. You do. You certainly want growth. And people don't understand that. They're like, either they're stuck in one world or the other. Growth, meaning you want the market to go up, right? Everybody wants their market to go up. Even people who are yield first, you want the market to go up. And so we always try to do our timing in these markets to make sure that we're working to try and maximize our growth potential. Now, some markets don't go up. Surprise! I know, it's crazy, but some markets don't go up. And in that case, you can still make money off the yield. All right. So I always use AT&T as the primary example. So if we come into AT&T, AT&T is one of the top performing yield stocks. All right. Now, it's it's abysmal, but it's one of the top performing yield stocks. You really need to have, if you're going to invest in AT&T, you really want it to have growth. So during this time frame, what's happening? Well, your growth is suffering, right? But you can still get yield. Now the yield is abysmal, and in this case on AT&T, the growth, which is down, negative, is going to way far out surpass the yield. So if we come over to this little chart here, we can pull up AT&T and we can see that it pays a yield, and a yield is a dividend, right? So the yield comes in here, and dividends are paid by traditional stocks. They're paid out every 3 months, right? Every quarter. So AT&T pays 27 cents per share every quarter. Well, pull out your little calculator, right? Pull up your little phone. Let's do the math. So how do you do the math, Lan? Well, it's very simple, because what they do is every 3 months, they're going to pay you 27 cents for every share you have. Well, that's pretty cool. We like that idea. Well, I love to get 27 cents for every share I have. And it's regardless of how much you paid for the share, right? It doesn't matter how much you paid for the share. They're going to give you 27 cents, almost 28 cents in this case, for every share you have. So we're going to say, well, if we have $10,000 invested in AT&T, we're going to put $10,000 into our little calculator, right? And then we're going to divide it by let's say the current price right now is $25.95. So we're just going to divide it by 25.95. That would say we'd have 385 shares. All right. Very simple, very easy math. Now they say they're going to give us 27.278 cents per share. Well, I have 385 shares. So I'm going to go times 0.278. 0.278 equals. They're going to give me $100 on my $10,000 every 3 months. That's called yield. All right. So you have yield and you have growth. The market itself, the rising price of AT&T is the growth. The yield is the dividends that they gave you. And you're looking at that and you're saying every 3 months they're going to give me $100. I know. It's almost like a why bother, right? Why bother? $100. The market fell. My $10,000 lost 25, 6, 7, 28, 29, 30. It lost $5 in the last month, right? $5 a share. And I have 100 shares. That's like, and you're telling me you're trying to make me happy because you give me 27 cents and I just lost $5 a share? That's growth versus yield. All right. So the yield on AT&T is tiny. It's tiny. All right. Okay. Let's use another example. All right. Let's go over to Apple, because Apple also gives you yield, AAPL. All right. So here's Apple. Today, Apple unveils the M5 chip with major AI performance. Okay. So they're getting a little bump in their stock because of that. All right. MacBook iPro is supposed to make them faster, sleeker, more faster. All right. More better. So we're excited about Apple finally doing something with their lives. All right. So Apple also gives a yield. Ooh, I'm so excited about Apple's yield. Let's do the math. All right. I think I got a little calculator. We can do the math on screen together, so I don't have to use my little phone here. Let's see if we got a little calculator here. CALC, and we can pull that up, and we'll just do the math here together on screen. Watch this magic trick. Okay, so now what is the yield? Oh, as soon as I click that, this is going to disappear. Silly screens. Good thing we got a big screen. How about that? I hope you guys can see this screen because it seems different than what we were using before, and it's a lot bigger. I hope you can see it. All right, so here we go. So we're going to come in here and we're going to do Apple's yield and growth. So the growth is they've gone from 210 to 263 in the last 3 months. That's some good growth. All right, 200 to 263. So we can say, roughly $63 a share. Now, how many shares do we have? Let's say we put $10,000 in there. 10, 1, 2, 3, 10,000. And we had, what do we say? 63 divided by 200 equals, that means we had 50 shares. So we went up, 50 shares went up $63 times 0.63. Well, you made $31 over that time frame. That's pretty good money, right? 50 times 60, that's 63 cents. Okay, put the extra zeros on there. $315. All right, so you made $315 in growth over the last 3 months on this thing, on your $10,000 investment, $315. That's pretty good growth, right? Not bad for Apple. So we made $63 over the last 3 months for every share we had, all right, for our $10,000 investment. Now let's see what the yield is. That's the growth. Now let's look at the yield. So the yield in this case, Apple gives away 26 cents per share. But AT&T gave basically the same amount of money, right? AT&T gave the same amount of money. So we go back over to AT&T just to remind ourselves. AT&T gave 27.8 cents, a couple pennies more. You're like, well, Apple's just as good as AT&T. No, remember, it's per share, right? Doesn't matter how many shares. I mean, it doesn't matter what you paid for the shares. They're going to give you 27 cents a piece. The difference is that in AT&T, we pay 26 cents or $26 for one share. And in Apple, how much do we pay? $200 per share. But it went up $36. So now we have to pay even more to get our 27 cents, right? Does that make sense? Does that make sense for cents? The number of cents you're getting? So here's your yield, 26 cents on a $263 share. Okay, so we got $10,000, and that's if you bought it today. We're going to do it at $200 though, because we're going to say we bought it at the bottom. All right, so we'll go $10,000 divided by 200 equals, that's 5 shares. $10,000 divided, that's 2,000. Land, come on, push your buttons. It's harder to do it with a mouse than it is with my little iPhone. So we got 10,000, 1, 2, 3, divided by 200 equals 50 shares. All right, so now we have 50 shares, and we get 26 cents times 0.26 equals. So we get $13. Wow. Apple is so kind, sharing their profits with us. Oh, don't we love Apple? Apple is so kind. They're giving us, $13 every 3 months for our $10,000 investment. Ooh, I just love Apple. Oh, they're so kind. Give us some share. Oh, share some of their profits with us. Apple's a joke. Apple's a joke. They don't share their profits with you. Oh, we made all this money. Yeah, well, finally they're kicking their heinies into the tail end of the business, and their stock's finally going up a little bit. All right. But you all know my take on Apple. They've been buying their shares back for the last 10 years. 1, 2, 3, 4, 5, 6, 7, 8, 9 years. They've been buying their shares back, and their sales have been flat. If anything, they're going down. And their earnings per share keeps staying stable. Why? Not because they're making money, but because they're buying their shares back. You have fewer shares, so you get higher earnings per share. Well, I got less shares, so I have good earnings. No, you don't. You bought your shares back, you sneaky little bums. So Apple's finally doing something, finally making some money. So that's good. Their trend actually looks a little bit like Tesla's, doesn't it? Tesla went sideways and then had that nice rally. So with the rest of the market. So you're getting your whopping 26 cents on a 263, and that was based on a $200 share. Now you have $263 you have to pay to get your 26 cents. So now let's say that we decide we're going to do this today. So now we come in here and we say we have $10,000 and we're going to divide it by 263. That means we only have 38 shares. So if you start today, you only have 38 shares to get your 26 cents from Apple, because they're so kind in sharing their profits with you. Aren't they kind? Oh, Apple's so kind. Give you 38 shares for your $10,000 times 0.26 equals $9.88 every 3 months on your $10,000. Here, Apple, take my $10,000 and use it for the purposes in which you need to grow your business. And Apple says, oh, thank you very much. Thank you very much, Chad. Thank you very much, Randy. Thank you very much, Lan. Here's $9.88 back every 3 months for your kindness. That's your earnings. That's your yield. Yeah, they suck. Let's just say what they are. All right, they're cheap bastards. Oh, damn it! Now I got. Oh, shit! Now I'm gonna have to go to YouTube confessional. I swore. I gotta watch my tongue. All right. So anyway, that's that. Okay. Now you understand, when we come back here to this little calculator, you understand what growth is, and you understand what yield is, and you understand why Apple is not on this list, and you understand why AT&T is not on this list. Why? Because they have shitty yields. All right. And if we're going to be yield first, meaning we want something that pays big yields, then we need to have something that is better than $9.88 every 3 months on a $10,000 investment, right? We're going to be yield first. Well, Lan, yield first has never been a thing. Nobody likes yield first because it's only $9.88. We know that. That's why yield, and everybody in the entire world has always been focused on growth. True. All right. Myself included. I would always come in here and I'd say, let's go look at the dividends. Why bother? They're only $9.88. It's going to move more than that in the first 2 minutes of the market opening. To blow that out of the water, it's worthless. Why even bother with the yield, the dividends? You'd have to be as big as, Warren Buffett to be able to have your dividends make any sense at all. So us as small speculators, we never pay attention to yield. That's why when you got on the YouTubes and you look around and you listen to people write articles, they hate all of this yield first investing because they don't understand it, for one, or they do understand it. They understand it from the old model. The old model is that it's worthless. All right. Why bother? Why bother? We're trading Apple for the purposes of getting the yield. $9.88 on a $10,000 every 3 months, just not worth it. So you can get better than that going down to Cash Valley Bank and putting your money into a guaranteed CD, right? So what we've now done is we've discovered over the last couple of years, there's been a couple of companies who have started doing something different. All right. They start trading what we call individual or single ETF stocks, stock symbols. All right. ETFs with a single stock symbol in them. Now, an ETF is generally considered an exchange traded fund. So an exchange traded fund is generally a basket of stocks that they make up, kind of almost like their own little mutual fund, right? They build a basket of stocks, they put all these stocks in there, and then they trade them equalized, or sometimes they'll weight it so that some have a little bit more than the others. But nonetheless, it's a basket of stocks, and you trade that one stock symbol, but you're actually being diversified across a bunch of stocks. So one example of that, if we come back over to our trading platform, would be, we could come in here and would be the Magnificent Seven, right? So that symbol for the Magnificent Seven, what is the Magnificent Seven? The Magnificent Seven is Apple, Amazon, Google, Meta, Microsoft, Netflix, NVIDIA, and Tesla, not AT&T. AT&T is not part of the Mag 7. Did I delete that? Delete chart. There we go. Okay, so it's these set 1, 2, 3, 4, 5, 6, 7. Oh, it's 8. Which one have I got in there? Netflix. Netflix is not part of the Mag 7. Apple, Amazon, Google, Meta, Microsoft, NVIDIA, and Tesla. There was actually another one. What did they call it? Now I forget. That had a couple more in there, and Netflix was one of them. Anyway, this is the new Mag 7. All right, Magnificent 7. These are the big 7, and these are actually, when you look at the S&P 500 and you look at the Dow, not the Dow, but the QQQ, the Nasdaq. These are the ones that carry the most weight for the entire stock market. All right, these are the markets that are actually causing the whole stock market to rally. Everything else is pretty sideways. If you look at individual stocks, other than these big ones, for the most part, the markets, I mean, they've been going up a little bit. They've been being pulled up by some of the AI stuff. But this AI growth is all done through these 7 stocks. And so they're the ones that are kind of carrying the water for the entire U.S. economy right now and causing these big runs, which is why everybody's concerned, right? Of course. So if we come in here and we pull up the one symbol that you can buy, which then gives you all of these symbols, right? It's just called MAGS, M-A-G-S. So that's one symbol that has all of those included. That's an ETF, an exchange traded fund. So you buy MAGS, and then it is diversified across the Magnificent 7. So you just only have to buy this thing. You don't have to go out and buy each one individually. Now, you might want to still go out and buy each one individually so that you can say, well, I like Apple better than I like Google. And so you'll put more money in Apple, less money in Google. So that gives you the ability to control the growth of your portfolio a little bit better. But if you're not interested in that, you're just like, well, I just want to have the Magnificent 7, and I'm not going to worry whether, Google grows a little bit more than Apple, or the Meta grows a little bit more than NVIDIA, or NVIDIA grows a little bit more than Amazon. You're not going to sit there and try and squeak out that last little 10%. You're just like, oh, I'm happy with just putting it in MAGS. You just buy MAGS, and they do that for you. All right. They kind of take care of all that for you, and they invest it for you on your behalf. And then you just participate in the growth. Now that's growth. So if we come back over here, now Track and Trade is a trading platform, but it doesn't have the dividends in it because it's all growth. All right. So we have to come over to this little silly program here. And this is the one that shows us the dividends. So if we come in here and pull up MAGS, M-A-G-S, all right, you can see that MAGS, they paid a dividend back here of 42 cents plus they got a bonus of 1 penny. All right, so they get 40. Let's just round that up to 43. Let's just say it's 43 cents. But that was clear back in 2020, beginning of January. So once a year, there looks like they're paying a dividend of 43 cents per share, and each share is 65 cents. So once a year, looks like MAGS is paying a dividend. That's yield. Okay, so if you're saying, well, I want to trade yield first rather than growth, you're not going to make a whole lot of money. So everybody's like, that's what's the problem out there on the YouTubes, right? Everybody's like, they've been so ingrained in that growth is the only way to go because in the past it has been. Growth has been the only way to trade. It is the only way you can make money. Buy low, sell high. The problem with that is, let's say you get into MAGS and you held it for, all the way into retirement, and now it's time to retire. What do you have to do to live off of your MAGS? You have to sell some, right? So you sell some. Let's say you make $130,000 this year in your MAGS, or you put 100,000 in. Let's say you put 100,000 in, and this year you made $30,000. Well, at the end of the year, right, you need to pay some bills, so you take $30,000 out. And the way you do that is you sell shares. Now you have that many less shares for next year to make more money, right? And so next year, if the market goes up the same amount, you make less money. You're not going to make 30,000 because you took 30,000 out by selling shares. This is the growth model. This is the problem with trading. And this is why people who are going into their retirement struggle so much. They're always worried they're going to run out of money, right? I'm going to run out of money. I'm going to sell all my shares before I die, and I won't have any money left, and I'll be poor at the end of my life. Won't have enough money. So everybody is in constant scared mode, not willing to sell their shares, because if they do, they might run out of money. They might live too long. I always say the solution to that is start drinking and smoking and, doing hard drugs. That way you don't have to worry about running out of money. Well, you might still run out of money because you'd spend all your money on drinking and smoking and drugs. But at least you wouldn't live forever. All right. So there are many solutions to running out of money. Die sooner. So here's another solution rather than taking up drinking, smoking, and hard drugs so that you don't live so long and you don't run out of your money. We could do a yield first investment strategy. All right. Yield first means that we're going to live off our dividends. You're like, but Lad, you just showed me over the last 10 minutes 15 minutes examples of why that can't work for you. You can't live off your dividends. They're why bothers. They're so tiny. They mean nothing. And you're talking about the best companies in the world. Apple pays such a shitty dividend. And this is MAGS, the Magnificent Seven, and it only pays 43 cents per dividend once a year. I can't live off that. I got to live off growth. No, you don't, because there's now a solution, right? Yield first. So now we have to find stocks or ETFs, exchange traded funds, that pay a bigger yield than they do a growth. Okay. And that's the whole name of the game. Switch from growth to yield. Because if we can just live off the yield, if we can make enough money, and what they've always said in the past is they want you to live off your yield, right? But to do that, you have to have about $2 million in your account to make your yield worth being able to live off of, right? So if you have $2 million in your account and you have a decent yield off of something like AT&T, you might be able to make roughly, $50,000, $60,000 a year on your $2 million, right? And then you don't have to worry so much about growth anymore. You can live off the yield and you don't have to sell your growth, and you can live off your $50,000, $60,000 in dividends. Well, a lot of us, right, don't have $2 million to put into MAGS, Magnificent Seven, so we can get our 42 cents a year. So what are we going to do? Well, we still have to live off growth. We're just kind of stuck living off growth. That's all we have to do. But that's not true, not anymore, because in the last 2 years, there's been several companies, as I mentioned, that have come up and said, hey, you know what? We're going to go with a yield first strategy. And how are you going to make more money in yield than you are in growth? How do you do that? What do you do? Well, these guys have come up with a nice little method. They actually trade the market. They don't just invest in it. Now, what's the difference? Trading means that you buy low, sell high, buy low, sell high, buy low, sell high, right? And you try and make more money than what just buying at the bottom and holding until you die, right? That's investing. You just invest in something, you hold on to it forever. And then hopefully you'd live off the dividends, but the dividends so tiny, you got to have such a huge amount of money to make that happen. We need to reverse that. We need to have big dividends with a small amount of money, as opposed to what we have now, which is small dividends with a large amount of money. All right. So we need large dividends with a small investment, not small dividends with a large investment. So we got to reverse that model. And so there's a company that's come out, and they're the one, in my opinion, that's doing the best on it right now. And they may get displaced. And this isn't a religion. This isn't Republicans against Democrats. We don't care. We're all on the same team. You and me, we're on the same team, right? I want you to do well. You want me to do well. We all want each other to do well. All right. This isn't us against the man. All right. I mean, the man, it's not two teams. It's us against the man. That's what I'm trying to say. All right. So the man is BlackRock, Vanguard, and State Street. To us, that's the man. All right. So we're all the little speculators. We're all on the same teams, like playing football. I might be, the running back, but you might be the quarterback, or I might be the quarterback. You might be the running back. Doesn't matter. We're all on the same team. We all still want to win. We're not the same guy. We're just all on the same team. We're retail traders. We want each other to do well. So when you go out on the YouTubes, you go out on the Twitters, and everybody's fighting, and we hate this. And we hate, and you're stupid, and don't talk like that. I'm sorry. I'm going to have to turn off my microphone for a second and take a drink of water. So frustrating for me to go out to those forums, and I'll put something up there like, oh, you know what? YieldMax Tesla is really good. And I get attacked. Oh, they suck. Oh, you suck. You're stupid for being invested in that. Oh, I can't believe how dumb you are. And I'm just like, dude, we're all on the same team. We're all trying to help each other make money. And I've made some good money with the Tesla model. So, don't tell me I'm stupid. I know what I'm doing here a little bit. I've been doing it for a while, and I've got some pretty good results. quit attacking me. I'm just trying to, give my opinion along in this little forum. That's why I don't go out and play in those worlds anymore. It's just ridiculous. It's just asinine to go out there and try and help people who don't want to be helped. They just want to fight. They just want to argue. It's the Democrat Republican thing. And I'm like, this isn't Democrats and Republicans. This is us all little retail traders trying to make money. Let's help each other. And if I got a little bit more knowledge, then you're saying something that you don't, it certainly shows your lack of knowledge. When I try to help you with your lack of knowledge, so I've tried to, hey, look, no, your math is wrong, right? You're doing it backwards. And let me show you how it works. And then they just get mad and bolts of fire come out of their ears and yell at you and call you stupid and all kinds of nasty names for trying to show them something. I just can't play in that world anymore. So, I'll just stick here and do my own little thing. It makes me want to pull back into a shell and say, why am I even trying to help people? My goodness sakes. It's such a vitriolic thing to go out there on these forums and try and help people. I just can't do it. I won't do it anymore. So you have to come to me now. If you want my help, you have to come to me. I'm not going to go to you. I don't care. I'm not going to go out there and try and help people who don't want to be helped. So you guys are here. You've come to me. Great. I'll show you what I'm doing. And it's working for me, and it's working pretty nice. And are there other ways to make more money? Yes, there are. Growth is a great way to make money. All right. Not gonna say growth isn't. We always want to have good growth. But we want to go yield first so that we can have bigger yield, so we can have bigger returns without having to sell our growth. Right? We don't want to have to sell our growth, but we want those bigger dividends so that we can live off that bigger yield. So it's called yield first investing rather than growth first investing. So we put yield first rather than growth. Now, the growth has always been the best way to do it because there's never been big yield investing. But now there is. And the best company out there, in my opinion, this is my opinion, is the Yield Max funds. All right. So they are new. They're only been out here for about 2 years. And so everything we're doing with them is relatively new, but we understand the concept because there's been other companies that have been doing very similar things, just in a different way. So we can take those models, those old models with the new math, and we can figure that this is pretty cool stuff. All right. So let me show you what's going on. So if we go out to YieldMax, yieldmaxetfs.com is the URL. They changed up their website, so it's kind of a little bit fancier, I guess. But you can see all of the markets that they trade, and they just trade all the big best markets, right? They got and they got a couple of their own that they create, like Mags. Mags is not Yield Maxes, but I'm saying like Mags. Mags is a ETF that's got a basket of stocks in them, right? Well, these guys do the same thing. They have several ETFs that have baskets of stocks in them, but they are for diversification, but they're their own stocks. They're their own ETFs. So they manage a bunch of ETFs, a bunch of exchange traded funds. Now they have a whole bunch of them. They have a whole list of them. In fact, my list right here is mostly, for the most part, not this one here, this one. This one here is mostly all Yield Max funds. Now it's not all of them because they keep adding more, right? And I have to keep updating this every month, but this is mostly Yield Max. Now there's some in here that are not Yield Max because there's another company that does these ETFs, these yield first ETFs. They're called Granite shares. So you can come over here, and again, this is not Republican and Democrat. Oh, Yield Max is better. Oh, it's Yield Max. I love the Yield Max, and I hate the it's not. Stop that. Stop it. Stop it already, please. Granite shares is not Republican and Democrat. You don't come in here and say, well, I like Yield Max, therefore I can't like Granite shares. No, you like the one that fits your model the best. This is not red and green, blue. Stop that. Drives me crazy. I love both because they're different and they produce different results for different purposes. All right. This is just two companies that are doing these high yield first strategies, and they do different strategies. Granite shares uses put options. All right. Yield Max, right? Look at the name, Yield Max. All right. Yield first investing, Yield Max, maximize your yield. That's the idea. That's why they name themselves Yield Max. I like it. Granite shares. Now they've got one in here. They call theirs Granite shares is the company. They call it yield boost. All right. So yield, again, they're talking about their yield first investing boost. Now they have a whole bunch of stuff in here that they do, but they got a little model of yield with that's yield first, yield boost. So we only talk about those because that's the only ones I'm interested in. Not that the others are not good, but these are the ones that are their yield boost. So their yield boost. Oh my goodness, I don't want all that stuff. Okay, so here's their yield boost. Now they've expanded this list quite significantly because it's so popular to do yield first now. A lot of people are jumping on the bandwagon like me, and I'm running out here and telling, it's so good. I'm shouting it from the rooftops, right? I think this is really good stuff. I like it. Now, is there, again, I go back, could you make more money doing other types of investing? Yes, you can. In hindsight, if we could trade in hindsight, we'd all be rich beyond our wildest dreams, right? We'd have all gone back and bought, we'd back the truck up, sold the house, sold the car, sold the kids, sold everything, sold the wife, right? So that we could get enough money to put it all into Palantir a year ago, and we'd made 300%. But we didn't know Palantir was going to go up 300% last year. That's why we didn't sell the wife, sell the kids, sell the house, sell the car, sell the barn, right? Sell the cows. Don't sell the motorcycle. But anyway, you do sell everything because you know that, hey, 300% growth in the next year is I'm going to sell everything I got so that I can have the money to be rich beyond my wildest dreams. Problem with that is you don't know the market's going to do that. So I always call it one in the hand, two in the bush, right? Well, Tesla might go to the moon. Everybody's saying Tesla's going to go to the moon. Might go up 300% next year. Why don't you just sell everything you got, put it into Tesla, and in a year you'll have more money than you know what to do with? Well, because Tesla might not go up, right? There's the unknown. But if we do yield first, we can invest in Tesla for some growth, but we're going to also make some yield along the way. And if the growth isn't that great, well, we still made the yield. All right. So yield is good. Yield is good. That way we don't have to sell our shares to make money because we get just the little dividend. But the dividends in these markets is big. They're big dividends because they sell options. Now, for those of you who don't know what options are, come to my class. We talk about options in this class a lot. So options are a way of gaining more money out of a market than you would otherwise, other than growth, right? So it's all a leveraged market. And so if you have leverage in your favor when you buy an option and the market rises, you're going to make a lot more money than you are if you just buy the shares. So that's leverage. But to get that leverage, you have to pay somebody some money to take the other side of your leveraged risk. And so the other side of that leveraged risk is where the premium comes in. And that's what these guys do. They collect the premium from people who want to buy options. All right. So if you buy an option, you buy the option from Granite shares, or you buy the option from YieldMax. And so you give them your premium so that you can have that added growth potential when you buy an option. And so that's where they get more money than just the growth. That's where their yield comes from. They get their yield from the premium of options. Now, you don't have to understand how options work. Just that simple little description will tell you where the money's coming from for these yield first investments. It's not just from growth. It's coming from people who are buying options and giving their premiums to these companies who then share that with us if we invest with them. All right, if we put our money into their ETFs, exchange traded funds. All right. So now those are the two companies that we're kind of focused on. Now there's others out there, obviously, but these are the two, Granite Shares and YieldMax. And it's not Republican versus Democrat. We're not trying to play this one's better than that one. No, they're different. All right. And I always say these in the markets. In the stock market, there's nothing that's better or worse than the other. All right. You can look back and say, well, that one made more money. Well, this one made less money. Well, which one's better? Well, you're going to say, well, the one that made more money is better. Not necessarily. It's just different. All right. It's a different strategy. So it has different results. And those different results might be better for somebody. Making less money might be better for somebody because it took less risk. All right. Or it had less volatility. I'm happy making less money if I don't have to sit through as much volatility, right? Or I don't have to take as much risk. So that lower yield might be better for some people. Whereas the other one, well, it made more money at the end of the year. Yes, but you had to sit through a lot of volatility and that was scary. All right. First of all. Second of all, it took a bigger risk initially. So you had a lot of risk. So you made more money, but you were paid for that extra risk with that extra money. So it's not that one is better than the other. They're just different. All right. So if you'll think about the market as not better and worse, just different. All right. There's many factors that come into why you might want to do one versus the other. And so that's the difference between Granite shares and Yield Max. All right. And you can say, well, Lan, which one's better? Which one has less risk? Which one do I want? You maybe want a basket of some of each. You don't want to just put all your money into one basket, right? You want to have a diversified account. That means you might have some Granite shares and you have some Yield Max. There's nothing wrong with having both, all right? And there's another one out there called Round Heel, but we're not going to go into Round Heel because we don't want to get too complicated. Again, there's several companies that are doing this. My two favorites are Granite shares and Yield Max. I like these too. It gives you a good solid rounding of what's going on. See, these are new. These guys are adding things. This yield first stuff they had 4 like last time I looked, and now look at their list. It's huge. So I'm going to have to go in and do some more research on this. I didn't realize look at how much they've expanded their list. That's crazy. NVYY, popular. TSYY, popular. KOI, popular. Those were their AMD. These ones that have popular by them, those used to be the only ones they had. That's why they're popular. It's all they had, right? It's the only ones they had. Now they've got, look at this. They've got AZYY, Amazon. So they've added Amazon. They got Bed Bath & Beyond. Is that what that is? Baba? Oh, no, that's BB. That's not Bed Bath & Beyond. That's a Chinese company. That's the Chinese Amazon. Baba is to China as Amazon is to America. All right. That's what Baba is. And then Bitcoin. Oh, they've got a Bitcoin one now. And then, of course, Coin. This is the Coney is the one that Yield Max does. Coin. So Yield Max has all these. Hood. That's what is that one? That's a Robinhood. And then Meta. And that's Facebook. And then MSTR, which is Misty. Right. Some of us have Misty. This is their version. NVIDIA, PLTR, Palantir, QQQ, SMCI. That's the chip manufacturer. SPY, the S&P 500, and then Tesla. So they got a nice rounding of stocks in here, funds. Now, these are all ETFs. They're single stock ETFs, meaning that that's the only thing they trade. So you're like, well, why don't they just, if it's a single stock ETF, why would they make an ETF out of it? Take one stock and put it into an ETF. Why don't you just trade the stock itself? Again, the reason they do that is because they're going to trade options on it in the ETF, and they're just like, well, why don't they just go trade options on the underlying stock? Because they want you to give them your money and they will trade it for you, and they need somewhere to put your money. So they put it into an ETF, then they take your money and they use that to trade options on the other stock with, and then the profits from what they do go back into the ETF. So how does that work? Well, let's come over here and look at one. All right. So again, we're going to come back over and we're going to look at Tesla. So we have Tesla. This is the stock for growth. Now let's look at the yield version, TSLY. All right. So this is a Yield Max version of Tesla. And you're like, it's not going up. This is the biggest problem with everybody out on the internets and out on the YouTubes and out on the social media stuff. They look at this stock right here and they say, why in the hell would I buy into that? I don't want to put my money in there. I want to put my money in this one. It went up. This one didn't go anywhere. It went down. And they're like, see, it's shitty. You'd have lost all your money. The growth side of the actual fund itself might go up and down, might go down over time. But what they're doing is the reason it goes down is because, remember, this is not growth. This is yield. This is the yield side. This is the growth side. So it's a pair. You have to look at them as a pair. If you want growth, you put your money in here. If you want yield, you put your money in here. Why does this just go flat sideways when the growth side went up? Why does the yield go flat sideways? Because they took the money out. And this is a representation of how much money's in the fund. They took the money out and they gave it to you. So it comes out of here and goes into your cash account. Now, remember, whenever you open up a brokerage firm, you open up your brokerage account. Your brokerage account has two parts to it. It has your cash, right? So when you deposit money from McDonald's, you go to work at McDonald's and you say, well, I'm going to invest it in the stock market. Well, you transfer it into the brokerage account. Well, it sits in cash. It doesn't go right from McDonald's into Amazon, or it doesn't go right from McDonald's into Tesla. It goes from McDonald's into a cash holding account in your brokerage firm. And it just sits there and it's not invested in anything. And then you take it out of the cash account and put it into different things. You might take some out and put it into Tesla. You might take some and put it into Apple. You might take some out and put it into Amazon. And then if you put it into Amazon, let's say you put some into Amazon, you put $10,000 into Amazon from your McDonald's money that's in your cash account. And then you buy some Amazon and Amazon goes up. So it goes from $10 to $12. And then you sell Amazon. That $10 that you initially put in plus the $2 that you made now goes back into your cash account, right? It's still in your brokerage firm. It didn't come back out. It didn't go back into your pocket over at McDonald's. It's just in cash account in your brokerage account. So now it's in your cash account. It's just kind of a holding box, all right? So it's just sitting there waiting for you to put it back into one of the stocks again so you can make money. And then you pull that money back, all right? So you have this little cash account. Well, if you take some of the money out of this cash account, think about TSLY as another cash account. All right. I know it's complicated, but you're taking your money out of your cash account and you're putting it into YieldMax's cash account. Does that make sense? Okay. So TSLY is YieldMax's cash account. So now what are they going to do with that money that you put into their cash account? They're going to invest it in TSLA, Tesla. And when they make money trading in Tesla, they're going to take the money out of Tesla and put it back into TSLY, which is their cash account, which is what you put your money into. You gave them money to trade. All right. So that's now their trading account, but you gave them money to trade. You don't trade TSLY. TSLY is a cash account for the company of YieldMax. Now they're going to take that money and go invest it into TSLA, Tesla. And then when they make money, they put it back into TSLY. That's why Tesla will go up and down a little bit over here. But then at the end of the month, or in this case, they do it every week now. They change. They used to do it every month, but now they do it every week. Every week, they're going to take the money out of their cash account and give you your profits back to you into your cash account. That's why that cash account doesn't ever go up, because they keep taking the money out and putting it into your cash account. So if they made $10,000 with your money that you gave them, and their $10,000 went from Tesla into their cash account, which is TSLY, and then they take that $10,000 and take it out of their cash account, which is TSLY, and put it into your cash account, what happens to their cash account? Does it go up or does it go down? It goes down, right? It goes up when they make the money from selling options over on Tesla, and that profit goes into TSLY, but then they just turn right around and take it back out of TSLY, which is their cash account, and they give it to you, and they put it into your pocket. Now you have the money, but they don't have it anymore. So if you're looking at the value or the price or the growth of their cash account, which is what TSLY is, it's not going to go up, because they keep taking the money out and giving it to you. That's how it works. Now, they have a whole bunch of cash accounts, right? They have one for every stock, all these stocks. They have a cash account for Apple. They have one for Amazon. They have a Google. They have a Mags. They have a Meta. They have a Microsoft. They have an NVIDIA. They have a Tesla. They have cash accounts for all of them. And they give them symbols in the stock market. TSLY is the symbol for their cash account that they're going to use that money to trade on TSLA for you on your behalf. That's what TSLY is. When you put your money into TSLY, it's just a holding account, a cash account for them to use your money to go trade TSLA with. Then it comes back to their cash account. Then they give it back to you. That's why TSLA is not what you trade. Right? TSLA is just a holding account. It's just a cash account you put your money into. Now, can it go up and down a little bit? Yeah, it does a little bit, because they don't give you all the time. Let's say they made $10,000 and you on your money, so they don't give you all $10,000 back. All right, so they give you $9,500 back. Well, if that's the case, well, then their little fund goes up a little bit. All right, because they didn't give you all 10,000 they made. They only gave you 9,500. So that's what causes these little moves like this. Okay, because Tesla went up really good. All right, so if you go over here, well, they made a lot of money right here. They were making big money selling, trading options on Tesla with your money that you gave them in Tesla. So they made a lot of money. Well, they promised you they were going to give you a certain return. It's on their website. They'll tell you how much they're going to give you, right? So they try to stay close to that. Now they can adjust it. It can go up a little bit. It can go down a little bit. They do reconciliations, and they just try to give you a nice little income and keep it kind of steady. So if they make a little bit extra this month, well, their little pot of money that they're using to invest might go up a little bit. But if they don't make as much money and they still give you some, well, it all equals out in the end. All comes out in the wash, right? At the end. So the whole idea is you want this to be as stable as possible. It fluctuates a little bit. Now, they had some of this kind of stuff because they probably lost a bunch of money when Tesla tanked, right? Tesla flushed down like this. So they didn't make any money. They lost money. They had a lot of money in their cash account, but they lost a bunch of it. So what happened in their cash account? Well, their cash account went down because they didn't make any money. You still have to have a market that's going up to make money, even in options, right? Now, you can make money when the market goes down a little bit because you got the options premium. But if the market flushes faster than what they can make options to cover the losses, well, you still lose money. You just don't lose it as fast. You don't lose it as much as if you were in the growth side. All right, that makes sense, doesn't it? If this is your cash account, you can see that, well, they had a bad day. They had a bad 3 months. They lost money. Yeah, who didn't know you could lose money in the stock market? Oh my gosh. Did you know you can lose money trading the stock market? You can. Believe it or not, you can lose money in this business. Oh my gosh, it's a revelation. You can lose money. Even these guys can lose money if a market tanks like this. Well, when a market tanks like that, it's hard to make money. All right. So when a market goes up like this, well, that's a lot easier to make money. Okay. And if a market goes sideways, even with options, it's a lot easier to make money. You can make money in a sideways market, and that's what's cool. Growth doesn't make money, but these guys made money the whole time through that time frame. All right. Now, it's better if the market's going up. We can make more money, but some money is better than no money. All right. And then some money, even in this case, they still had money coming in, but it didn't cover the losses. The losses were bigger than the money coming in. But if you didn't have money coming in and all you had was the losses on growth, well, you had a bigger loss than what YieldMax probably experienced. All right. So that's how this whole program works. And we got different ones for all of them. So you can have a little cash account for all of them. So that's why when you look at this chart, you're like, oh, well, I don't want to be in this market. It's just going sideways. Well, it's going sideways because they're making money and they're giving it to you. They take it back out of here and give it to you. So if they take it out of here and give it to you, it's not in there and it can't go up. If you wanted that to go up, well, then they wouldn't give you any yield. Right? So they're making yield. Well, how much are they making, Lan? Let's go do the math. Let's come over here, and we come over to, oh, not this one, because it doesn't do, we have to go to this one here. Okay, so we're going to come over here, and we're going to go into Tesla. Let's go to Tesla, TSL. So we got TSLA, which is the growth, right? That's the growth. Now we're going to go over to their cash account, TSLY, and we're going to look at the cash account for YieldMax. They use this money to invest in Tesla with. Well, how much yield are they giving? All right, this will tell us the yield. And it has no growth because they give the growth to you. How much do they give to you? Well, they give you all the growth. And that's what these little things down here, these little circles at the bottom tell you. So let's do this one because this is starting to get weekly. We'll do this one. They're giving you 80 cents. How much did AT&T give you? What did we say? 25 cents, right? Every quarter, they gave you 27 cents. Every 3 months, they gave you 27 cents. Now, a share was $26, right? And Apple was $230 for the same 27 cents. Keep that in mind because we have to compare apples to apples. All right, now let's come back over to Tesla again. TSLY, which is Tesla's cash account for them trading in TSLA. When the money comes in here, they turn around and just give it right back to you. All right, that's why it doesn't go up, because they're taking the money out and giving it to you. And how much are they giving? Well, they gave 80 cents per share. 80 cents, not 20, 80. And the share price is $8, not 200. Okay, well, land. Do the math for me. Where's your little calculator? Okay, let's put the same $10,000 in and see if this is a why bother or not. $10,000 divided by how much does this share cost? Now, remember, they give you your dividends based on shares, not on how much you paid for them. So our share is $8.48. 8.48 equals. So we'd have 1,179 shares. So you really don't want their cash account to go up. Because if it goes up, now you have to pay $14 for it instead of $8. If it's at $8, you can buy a share and get 80 cents per share for only $8. And you're sitting there going, I want my TSLY to go up. No, you don't. Because if it goes up, let's say it goes from $8 to $16. Now you have to pay $16 to get the same 80 cents on a dividend. Right? Does that make sense? You don't want this TSLY to go up. You want it to stay as flat as a pancake. All right? So now we got 1,179 shares times 0.802 times 0.802. So now with our $10,000 every month, not every quarter, like in AT&T or in Apple, this is every month. Every month, they're going to give you $945. That's called yield first. I'm more interested in the yield than I am in the growth. The growth is nothing, and I'm happy about it. Because next time, now I have $945, I can buy more shares with at $8.48. That's called exponential compounded growth. And it's one of the 7 wonders of the world. And you can be rich, rich, rich beyond your wildest dreams if you do this yield first strategy. And you can live off of it. Look, $945 on a $10,000 investment every month. Yield first. If you just understand the concept and not go out there on Twitter and not go out there on YouTube and fight with those guys about, I feel bad for everybody who holds TSLY. Those guys are a bunch of chumps. Well, I hold it and I make a lot of money. Well, you must be a chump. Okay, I'm a chump. I am a happy chump. I'm one happy chump. For every $10,000 that I have in TSLY, every month they give me $945. You can't get that at Cash Valley Bank. All right, guys. And I'm going to tell you something. I document all this stuff in a service that I created just to teach you all this stuff. And I don't know why, out of the kindness of my heart, I'm making $945 a month out of every $10,000 in there. And I got $1 million in there. Now, not just in TSLY, but in a basket of them. I got $1 million in there. You do the math. How much money am I making? And why am I sitting here teaching you how to do it? I don't know. I got FU money. Right? I do it because it's fun. I like to teach. I like to show. I like to share. You guys are my friends, and I want to share this stuff with you. All right? I want to show you how it's done. I'm so excited about it. I want to share. It's like pilots. How many of you guys fly airplanes or ride motorcycles or have fancy cars or something? You just want to talk about your hobbies to everybody, right? You want to go find a group of people. That's what we are. We're social animals, right? Humans are social. We like to go find a group of people that are like-minded to us and share our ideas and concepts. Oh, I like to ride motorcycles. Oh, I like to fly airplanes. Oh, I like fancy cars, right? To me, this is the same thing. This is my passion. I love it. I've been doing it for 40 years, right? Oh, I see these little charts. I get so excited. And so I like to talk to people about it. You're my little group of groupies, right? We all get together. We talk about, not motorcycles, not airplanes. We talk about stock charts. Oh, wow. Look what I found. Look what I discovered. I'm not the one who actually found Granite shares, right? I didn't know Granite shares had those funds. They're brand new. They came out. They got announced. And one of our students, one of my friends, called me up, sent me a text. Hey, did you see what Granite shares is doing? No. What's Granite shares? Oh, they're doing the same thing Yield Max, only they're doing it with put options. Oh, I'm so excited about that. I want to go see it. And so I ran over there. One of my students introduced me to Granite shares. All right. They didn't have to teach me. I understood it as soon as they told me what they were doing. Oh, I know what that is. Oh, that's cool. I really love that. And I started putting some of our friends, my friends, some of our students into granite shares, saying, hey, you guys might want to put some granite shares up along with your TSLY, have a little bit of both. And so we got students who are in granite shares, right? I had some granite shares. I moved them into Tesla. I did some rebalancing and took it out of granite shares, put it back into yield max. But there would be a purpose and a time to go back into granite shares. It's a different strategy. So you can use it strategically. All right. And I write all this stuff down. All right. I have a magazine that I put all this stuff in.
Ready to level up your news game? Welcome to Pitt News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pittnews.com. That's pitnews.com, Pitt News Magazine. News your way.
All right, so that's my little passion project. That's my little side hustle. I like to have Pitt News Magazine so I can write all this stuff down, and it's fun for me. It gives me something to do. You know, this is my only job. Come in here and teach at the university and teach you guys on YouTube and have my little magazine, and it's just my little world. And so if you want to join my little world, go and subscribe to Pitt News Magazine. Come back to these little classes that we have here, and we'll just keep doing it. All right. And for those of you who are in the St. George area, come down and join us tonight at the university. We're going to have a class. We're in the Udvar Hazy building on the 2nd floor. You can find us. It's not that big of a building. If you don't know where the room is, I think it's 207 or something like that. Just look around. You'll see a bunch of guys talking about stock charts. All right. 6 o'clock tonight, Udvar Hazy building. And if you come down, you're not registered yet, and you sit in the first class, and you decide you want to register, you can go register at the university afterwards. All right. But you're welcome to come down and join us. We'd love to have you. And we will see you guys, I guess, tomorrow afternoon. We're going to do the, actually, we're going to change things up. School's starting. So tomorrow we're not going to do the afternoon session. We're going to do we'll probably do another morning session tomorrow. All right. So watch your schedule. Things are changing. The university's starting up. So I've got to do the labs now for the actual classes that I'm teaching. So tonight we have class. Tomorrow will be the lab for tonight's class. So tomorrow we will be discussing in this lab the things that we talked in class last night. All right. So we practice what we preach. We're going to preach tonight at the university. We're going to practice tomorrow morning on the YouTubes. All right. So we will see you guys in class tonight. All right. Or tomorrow morning. Take care.
All right. That wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.